and Assalamualaikum. My name is Siti Asma binti Muhammad Adnan. My ID number ACP 01083674. Today, I want to explain to you about the rise and fall of management accounting based on article written by H. Thomas Johnson and Robert Kaplan in 1987. So, based on this article, it's important because it shows how management accounting started as a powerful tool for manager but later become less relevant. Why management accounting rose? In the early 20th century, big companies like DuPont and General Motors faced the challenge of managing large-scale production. Management accounting systems were developed to measure cost, efficiency, and productivity. At that time, the system was very useful. Tools such as budgeting, standard costing, and variance analysis help managers plan operations, control costs, and improve decision-making. In short, management accounting rose because it was timely, relevant, and closely connected to the business needs. Consequently, why management accounting fell? However, by the middle 20th century, management accounting began to lose its relevance. Reports became too late, too aggregated, and too difficult for managers to use in daily operation. Instead of focusing on the key drivers of efficiency, like quality, innovation, and process improvement, the system distracted managers with outdated cost variance and historical numbers. Worse still, the system was shaped by financial accounting rules, many cash outlays that could create a future benefit, such as investment in training or technology, were simply treated as expenses. This reduced the usefulness of the information for decision making. As a result, management accounting fell because it became slow, outdated, and more focused on external reporting than on helping managers improve productivity. Next, challenges of the management accounting. In their seminal 1987 article The Rise and Fall of Management Accounting, Johnson and Kaplan highlighted several critical challenges that caused traditional management accounting to lose its relevance. The first challenge was the problem of irrelevant information. Reports were often produced too late, too aggregated, and focused largely on historical outcomes. This means they offer a little value to operating manager who need timely and detailed data to reduce costs and improve productivity. The second challenge was a lack of understanding among managers. Many operating managers found management accounting reports difficult to interpret, which limited their usefulness for daily decision making and performance improvement. And then, Johnson and Kaplan emphasized the failure to adapt to changing business environment. While management accounting had been designed for mass production in the early 20th century, by the 1980s, businesses were facing global competition, advanced automation, and just-in-time systems. The old methods no longer meet these new demands, leaving management accounting outdated and strategically weak. So, this challenge demonstrates why Johnson and Kaplan argue that traditional management accounting had failed. It no longer provided relevant, timely, or strategically useful information to managers.
So next is the opportunity. In the article, it is about what is happening right now in our modern time. Nowadays, companies demand more accurate and timely management accounting information. Thanks to the technology, data can be collected in real time and processes can be tracked automatically. This has made information much cheaper to gather and analyze. So we no longer need to rely on old, which is the simplified methods. Instead, we can design systems that are more accurate, more timely, and more effective to support better decision making. On the other hand, academics were actually led astray. Most researchers focus on simplified models, like a firm with only one product and one production process. They talk a lot about fixed and variable costs, but never really explain where fixed costs come from or how to allocate them across many products. Researchers also didn't test their ideas in real organization with complex operation. As a result, companies kept using outdated systems while executives made decisions based mostly on short-term numbers like earning per share or return on investment. But in today's business world, with higher costs in areas like research and development, design and training, those traditional financial measures are no longer enough to reflect true performance.
We move to the third part of this presentation video, which is we're gonna talk about the roots of management accounting system, whereby we talk about the timeline on how the management accounting system is being practiced by all the organization in the early of 19th century, middle of 19th century, and also early of 20th centuries. The first one is the birth of internet system occurred in the early 19th century, which is the management accounting began to emerge as businesses expanded during the Industrial Revolution. Before this period, success was measured simply by whether more cash was collected from sales than was spent on labor and also materials. However, the growth of large factories, textile mills, railroads, and also steel companies created the first hierarchical managed enterprises. These organizations required information about internal operations rather than just external transactions. Early management accounting systems were designed to measure conversion costs such as labor, material, and also overhead in order to evaluate efficiency. Measures such as cost per labor hour and also cost per pound produced were commonly used at that time. And this stage, management accounting operated independently from the financial accounting as the two systems were serve different purposes. Now we move to the next part, which is the growth of management accounting in the middle of 19th century, which means the advances in transportation and communication, particularly in the railroad and also the telegraph, enabled businesses to expand across larger geographical areas. This development created a need for more sophisticated management accounting system to coordinate with logistics, production, and also distribution activities. Railroad corporations pioneered these practices by using measures such as cost per ton mile and also the operating ratio, which compared revenue to operating costs. Distribution and retail enterprises also required new measures that focus on purchasing, pricing, and retailing efficiency. These include gross margin by department and inventory stock turn, which track how quickly stock was sold. During this era, management accounting served mainly to improve internal efficiency and to evaluate the performance of managers with less emphasis based on calculating the overall profit of the enterprise. The last one is in the late 19th and early 20th century, whereby they saw significant advances in management accounting driven by the scientific management movement and also the growth of diversified operations. Under the influence of Frederick Taylor, physical level and also material standards were established and converted into standard costs that help managers make better pricing and efficiency decisions. At the same time, large corporations such as DuPont and also General Motors need tools to coordinate diverse divisions. They introduced the return on investment measure, which assess profitability relative to capital employed. By the 1920s, ROI became central to decentralized organizations where division managers were accountable for their own results. By 1925, nearly all modern management accounting practices, including cost accounts, flexible budget, standard cost, variance analysis, and also ROI had been developed. However, after this period, innovation slowed, leaving a gap between traditional management accounting system and also the growing complexity of corporate technology.
Assalamualaikum warahmatullahi wabarakatuh. My name is Nurul Syahada binti Syahidah. So, I will be explaining about the loss relevance in management accounting. So, by the year 1925, almost all of the management accounting practices that we still use today had already been developed. These included cost accounts for labor, material and overhead, budgets for cash and incomes, flexible budgets, sale forecast, standard cost, variance analysis, transfer pricing and divisional performance measures. These tools were very advanced for their time and were designed to help managers control costs and make better decisions. However, after 1925, innovation in management accounting started to stagnate. Even though corporations were becoming more complex and production technologies were improving, management accounting did not keep up. As a result, problems began to emerge. Product costs became distorted, reports were delayed, and short-term performance measures often failed to reflect the true economic position of a company. So, one of the main reasons for this stagnation was the dominance of financial accounting. With the rise of shareholder ownerships, external auditors demanded conservative and reliable financial reporting. This focus on audited statements shifted attention away from developing more accurate and responsive management accounting systems for internal use. Over the time, this created a major gap. Managers have limited real-time information and cost systems remain rooted in the old design of the 1920s. Even when digital computers arrived in 1916s, companies simply automated outdated manual methods instead of rethinking and improving the systems. The key message here is that management accounting lost its relevance because it failed to evolve with business needs and technology. While production and corporate structures advanced rapidly, the accounting systems stay almost the same. This means that managers often lack timely and accurate information to make strategic decisions. In conclusion, the article highlights an important lesson. Management accounting must continuously innovate. If it remains stuck in old systems, it risks losing its relevance, just like what happened in the 1925. So that's all from me. So I will pass to next presenter.
So now, let's begin with a story from the 15th century in Venice. Merchants at that time often invested caravans with each a long trading expeditions. For example, a group of investors might buy goods in northern Italy, sell them to India, sell the goods there, then buy the tea to bring back and finally sell the tea in Venice. At the end of the journey, the accountant would calculate the overall profit by subtracting the total cost from the revenue of selling the tea. This profit was then distributed among the investors. But here is the important thing. Nobody asked what is the profit in the third quarter while the caravan was crossing the desert. This question would have been meaningless because profit could only be measured when the journey was complete. Instead, during the journey, what was really mattered was the progress indicator. How far the caravan had traveled, how many provisions were left, the condition of the goods, and the morale of the workers. The lesson here is clear that in long venture, short-term profit does not tell us much. What matters more is whether the caravan is making progress and moving in the right direction. Now, if we connect this to modern management accounting, we will see a similar issue. Many organizations still focus heavily on quarterly profit reports, but like the caravan, these short-term numbers can be misleading. A company may appear weak in one quarter because it is investing heavily, but in reality, it is on right track towards long-term success. What companies should focus on are better indicators of progress, such as cash flow, productivity, customer satisfaction, and innovation. These measures are much more useful in showing whether the organization is healthy and sustainable. This is where innovation in management accounting comes in. Traditional systems are too focused on short-term reporting. Today, with modern technology, we have the ability to design systems that provide more relevant and strategic information. The real challenge is not the lack of tools, but the need for knowledge and creativity to design the system. By encouraging experimentation and communication between managers and researchers, we can recapture this innovative spirit of the past and build a accounting system that truly supports strategy, decision making, and long-term success.